Welcome back. I have a different but interesting video here. So what we're doing is we're going to take a very optimistic case for Tesla and then do a stock valuation based on that. So I'm going to run through my usual exercise through the financial statements to judge competitive advantage and financial health. And then we're going to have a little episode of When Worlds Collide and use formula from Intelligent Investor, the founder of value investing himself, Ben Graham, use his formula to come up with a valuation for Tesla using the optimistic but still realistic assumptions and see that we can actually get pretty close to the share price. All right, so let's get started. I'm going to go through this first section really fast. So our PE is 345. That's like 20 times higher than I usually like to see. Price to book is almost 40 and price to sales is 25. Okay, so first glance, traditional value investors might look at this and just run away as fast as they can, but it's going to be closer than you think. That's all I got to tell you. All right, the 1 year high, 1243. I think that's the only thing we have going for us. I'm moving over to the chart now. So since that high, we're down about, let's see, what are we down? 15%, 14%. And just look at this. Over the last 2 years, if you were a shareholder, you had a 10 bagger up 1,026%. That is awesome. All right, so let's get started with the financial statements. First up, revenue. Look at this growth. This is what an exponential graph looks like. Nothing bad to say here. Usually we only want to look at revenue and make sure that it's growing, but this is on the huge exponential up. So that's always going to lead to a higher multiple than something that's not growing this fast. All right, good sign. Next, we're going to look at what's next, gross margin. All right, let me change this to percentage. All right, so why do I love gross margin? Because it's a great way to judge a company's competitive advantage and how good of an industry it's in, right? If it's in a super competitive industry making low gross margins, that's not a good sign. That means that if it tried to raise its prices a little bit to get a little more profit, that it would lose market share. So you can see Tesla's gross margin over 20%, growing recently almost as high as 30%. So to put this in context, and I did 2 videos, one on Ford and one on GM, their gross margins were closer to like 15%. So they're almost double. Tesla's almost double. Gross margin, in case you didn't know, is revenue minus your cost of goods sold. So you can think of it as all of the sales minus the cost for their raw materials, their pieces and parts to make the vehicles. All right, and then I didn't point this out already, but this data is going back to the first quarter or the last quarter in 2008. So the last quarter in 2008 all the way till now. This is all the quarterly information. All right, what's up next? Interest over gross profit. So what this is going to tell me is it gives kind of an idea of the financial health of a company from a debt perspective. So sometimes you'll see companies that are relying heavily on debt to make money, and they pay out a huge percentage of their profit as interest. So I'm going to get rid of these first 3 quarters here just to make the scaling work a little bit better. Okay, so look at this. They were paying a lot of debt at the beginning, but now they are relying less and less on debt. Look at this recently, 2 and 3%. So they have almost no debt compared to what they're making. That is a great sign. Really like to see that, and that gets a huge check mark from me. Going to pre-tax income. So this is a great sign too. They're profitable and growing rapidly. So one other interesting thing I want to point out here, if you remember that 2-year share price history I showed you, the stock's up, 10 times. And I think a lot of people blame that on the Wall Street bets apes and stuff, the people just holding and waiting out the shorts and squeezing them. But I think none of that would have happened if it wasn't for the catalyst here in this earning. They definitely have solid fundamentals behind those movements. So unlike the case of some of the other ones, but it's just interesting. Let's go to our earnings per share. Still no red flags. We got all check marks. All right, similar pattern to our pre-tax income. This is going to be similar always, most of the time, unless there's a big tax write-on or write-off. But what I'm going to do is I'm going to use this to get a number. So what I'm going to do here is take the last earnings per share for the last quarter, so $1.50, you can see 150 multiplied by 4, and I get $6 per share. I'm just going to record that here in the outline section. All right, let's go to the balance sheet. So before I start with the balance sheet, I just want to say, if you're interested in this type of thing, stock valuation, I got a lot more companies on my channel, a lot more traditional valuations. This is more of a learning opportunity for high growth companies. Check it out on the channel and then subscribe if you like it. All right, inventory. So inventory is really interesting to look at, but you don't want to look at just total inventory. You want to look at it broken down as raw materials and finished products. So raw materials are your pieces and parts, and then your finished products are just like it says, your finished products. So real quick, raw materials, we want to see, okay, so this is going up. Okay, we want to look at that combined with finished products. Finished products, finished goods going down. All right, this is incredible. This is like the golden sign for companies, for manufacturing companies. So raw materials going up, that means that the company's trying as hard as it can to get as much materials in because it sees a lot of sales in the future. So it's trying to stockpile because it knows it's going to be able to turn those into finished products and sell them. And usually if raw materials going up, finished products also going up because they kind of move together. But to see raw materials going up and your finished goods going down, that means that your products are being sold so fast that they're not even accumulating as inventory. So this is, great sign. Like I said, golden sign as far as manufacturing companies go. Huge check mark. I wanted to point that out. Always look for that with manufacturing companies. It's less important with other type of companies. All right, let's go to tangible book value. So tangible book value is kind of like a liquidation or net worth of the company. And you always want to look at this and make sure that it's growing. So this is all the assets minus all the liabilities minus all of your intangible assets. So this is growing. I mean, that's an understatement. It's also on an exponential curve. Look at this growth rate. So 1 year ago, or 2 years ago, the quarter ending September 2019, they were at $5.5 billion for tangible book value, and now they're above 25. So look at this growth rate, 26.5 divided by 5.5. That's over 2 years. Over a 2-year period, they went up 4.8 times. So almost 500% in 2 years on tangible equity or tangible book value or net tangible assets. All those mean the same thing. Huge check mark again. Nothing but positives piling up here for Tesla. All right. Now I want to show you the first, minor blip, ordinary shares number. So this is not dollars. Let me get that away. Okay, so this is how many shares outstanding. So increasing here would mean that the shares are getting diluted, and decreasing usually means that they're buying back shares. As a shareholder, you do not like to see dilution, and you generally like to see the company buying it back because that usually means that those shares are undervalued if management is smart and rational, which isn't always the case. Dilution here, I think, actually kind of makes sense just because we know the stock price is pretty high compared to its earnings and everything. So it makes a little bit of sense that management is diluting. I'm not a big fan of it, like I said, but it's not a huge red flag. It's not another green check like everything else. So take it for what it's worth. All right, let's go to the cash flow statement. First up, free cash flow. Free cash flow is your cash brought in from operations or your cash brought in from your operating equipment. And then you subtract out your CapEx, which is capital expenditures, your reinvestments back into that equipment or the purchase of new equipment. All right, so their free cash flow is pretty low and they do have some negative quarters. That's a little concerning, but if it's due to high CapEx, that's not a big deal. So what do I mean by that? Like I said, free cash flow is operating cash flow minus CapEx. So we're going to break it down. We're going to see, is it coming from a low operating cash flow? Not really. I mean, look at this. You're above 2 billion most of the time. It's not coming from that. I suspect we're going to see high CapEx because of that. Yeah, okay. This is not a big deal. So they're spending a lot in capital expenditure, but they're growing. So that's really the only way that you can grow a company, or the most common way you grow a company is through capital expenditures. You have to buy new operating equipment that's going to operate and make you money. So this is okay. In general, though, if you see big capital expenditure and you do not see growth in earnings or at least revenue, you should be very concerned. It should be sounding off alarms in your head. Like I said, though, the growth was visible in the income statement. I'm not concerned with high CapEx. All right, usually we go straight to valuation here, but we haven't gotten a growth rate yet, and we're going to use Tesla's own PowerPoint to get a growth rate. So let me pull that up. Okay, so what we have here is Tesla's Q3 2021 PowerPoint to investors. And you can see here they've listed some key quarterly metrics, okay? They only have 5 of them, right? Net income, EBITDA, operating cash flow, free cash flow. We just looked at these two. We looked at this one in the income statement. This one is the one I am focused on. Vehicle deliveries, units. So how many vehicles did they deliver that quarter? And look at this growth in 2 years. So from Q3 2019 to Q3 2021, they went from delivering 100,000 vehicles to 250,000 vehicles. So just to put that into perspective, that growth is 250 divided by 100. To get that annualized, you do raise to the 1/2, subtract 1, and that's 58% growth year over year. That is a super high growth rate, but Tesla is growing a lot. Like I said, though, this is going to be a very optimistic valuation, so I do want to try to use that growth rate. However, before you commit to a high growth rate in any valuation, you really need to look in market share. So that's what I'm going to do. Here's some cool pictures of their facilities. All right, where's market share graph? All right, here it is. Let me try to zoom in for you. All right, so this is the market share of Tesla vehicles by region. So we got US, Europe, and China, and this is light duty vehicles only. So look at this market share. In China, they have like just a little over 1%, same as Europe. And then in the US, they don't even have 2% of the market share yet. So there's plenty of room to grow. So you got to ask yourself, is it realistic to expect them to grow 58% for the next 3 years, let's say? So to grow 58% in 3 years, 1.58, you raise that to the 3. So their number of vehicles would have to quadruple in 3 years. What does that look like from a market share standpoint? China would have to be 4 to 5%. Europe would have to be 4 to 5%. And then the US, Canada, if that got, close to 10%, that would be there. Is that unrealistic? I don't think so. I mean, they've obviously had amazing growth. You never see market share growth like this. That's almost on an exponential. So I think it's realistic, but optimistic. That's the kind of theme of this video, right? And remember, for other valuations, if you're going to use a high growth rate, always look at market share, because let's say that a company's growing a lot, but they already have 80% of the market share. They're not going to be able to grow 20% a year if you already got 80% of the market share, right? That's an extreme example, but you get what I'm saying. You need to have market share room to grow. All right, let's go to our valuation. So like I said, we're going to take the optimistic scenario. So I'm not going to use this pre-tax basis valuation, and I'm actually not going to use the DCF either. What I am going to do though is use this formula, and this is the one from The Intelligent Investor, from Ben Graham. All right, so it's actually on page 295 of this version. I'm going to read it to you real fast. Value equals current earnings times 8.5 plus twice the expected annual growth rate. One disclaimer here, though, is that their growth rate is supposed to be an expected one over the next 7 to 10 years. We did 3 years. So what? I wanted to do it like this. All right, earnings per share, 6 times 8.5 plus 2 times our growth rate, which if you remember was 58%. And we get a target price of $747. All right, so this number, still about a quarter off from the current share price, but a lot closer than I think a lot of people, including myself, were expecting if you told them to just give you a ballpark valuation on Tesla. Like I said, the PE alone made me think it was 20 times overvalued, when in reality it's probably a lot less than that overvalued. One other thing to keep in mind here, though, is that I did an optimistic case on car manufacturing alone. We don't know what else Tesla's going to go into. We don't know what Elon's capable of. I could totally see if you add in those other things, you might have a hard time convincing somebody that this actually is still overvalued. It still could have room to run. I do want to thank the YouTube channel Everything Money and their interview with Mohnish Pabrai, because that's kind of what inspired me to take another look at Tesla. Their interview, it's part 4 of their interview especially, and I'll link it in my description, was really informative and a super cool lesson in value investing, in my opinion. They talked about Tesla, and they also talked about Microsoft, which I have a video for as well. As far as my position on Tesla, I don't have one now. I'm not planning to open one in the future. I'm kind of in the same boat as Charlie Munger, who's our quote up top today on Tesla. I see great potential. I don't think it should be shorted. I'm just not buying it yet because, I mean, obviously, right? I hope you enjoyed the video. I hope you learned something. If you did, please like and subscribe and check out the channel, and I'll see you next time.